Today, we're going to discuss the importance of two asset types which are crucial for any business: net receivables and prepaid expenses. When a company sells its products, it does so on the basis of either cash upfront or payment due 30 days after the purchaser received the goods. In some businesses, the cash isn't due for even longer periods of time. Sales in this state where the cash is due are called receivables. This is money that is owed to the company. Since a certain percentage of the buyers will not pay, an estimated amount for bad debts is deducted from the receivables, which gives us net receivables. Receivables minus bad debts equals net receivables. Net receivables as a standalone number tells us very little about the company. However, it does tell us a great deal about different companies within the same industry. In very competitive industries, where companies will attempt to gain an advantage by offering better payment terms, instead of 30 days, they may give vendors 120 days. This will cause an increase in sales and an increase in receivables, but it may also increase bad debts. If a company is consistently showing a lower percentage of net receivables to gross sales than its competitors, it usually has some kind of competitive advantage working in its favor than the others don't have. In other cases, businesses sometimes pay for goods and services that they will receive in the near future, although they have not yet taken possession of the goods or received the benefits of the service. Even though the goods or services have not been received, they are paid for, so they are assets of the business. They are noted as current assets in the account for the year ahead, which are paid in advance. These are called prepaid expenses. Other current assets are non-cash assets that are due within the year but not as yet in the company's hands. These include such things as deferred income tax recoveries, which are due within the year but aren't cash in hand just yet. In conclusion, understanding the dynamics of net receivables and prepaid expenses is paramount of evaluating a company's financial health and competitiveness within its industry. Net receivables, derived by subtracting bad debts from receivables, unveils a company's effectiveness in managing credit and its relative standing in a competitive market. On the other hand, prepaid expenses as current assets illustrate a company's commitment to future goods and services, shedding light on its financial planning and liabilities. By delving into these key assets, investors, analysts, and business owners can gain valuable insights into a company's strategic positioning and financial viability.